life on the Money Show, we make sure that we just don't talk about investing in mutual fund, but also help you meet the brains behind these funds. And this week's Meet Your Fund Manager segment, we have on board Sohini Andani, Fund Manager, SBI Mutual Fund. Let's welcome her on board and understand more about SBI Magnum Midcap Fund. Sohini, a very rare appearance. Thank you so much for making time for this special interaction today. You know, I have to inform the viewers it's very difficult to get Sohini out of her AMC office and get her live in the studio with us. But thank you so much. So, Sohini, as we all know about midcaps, you know, midcaps have the potential to deliver superior returns because mid-sized companies definitely are in a growth phase. And even historically, Sohini, midcaps have performed better than large cap, you know, when it comes to the long-term strategy. But what about the current rally? What are you sensing about this current rally? The million-dollar question is, have the valuations gone really high? Are they very expensive? How long do you think the rally would continue? Which everyone wants to know.
Sure. So when we look at it from how the markets or especially the mid-cap segment has moved from the COVID lows, the returns have been quite significant. When you look at it from a 5-year perspective, what we are seeing is that the returns in the mid cap segment have been in the range of 17-18% CAGR. From which is I think it tracks higher than the earnings growth that we've seen in last 5 years. So definitely, the valuation premiums have gone up, and this happens, as and when we expect that the earnings momentum is going to pick up because the market is seeing it, 2 years forward. So hence, I think definitely the valuation premium on mid caps have gone up. But also what we are seeing is that the upward revision in earnings, which has started for some time last year and is still continuing at the moment. So I think that is driving the valuations up, and obviously the fund flows that we've seen, both the FIIs and domestic investors are putting money into the market, and hence that is fueling the rally, I would say, in the segment.
Exactly. But then now let's talk about the fund. Sohini, and SBI Magnum Midcap has a track record of more than a decade, as we all know. You know, slight periods of dull performance, but then later the fund has picked up, and especially in last 2 to 3 years, we've seen the fund performing really well despite the volatility. And now, since we're talking about volatility, what I want to know from you, Sohini, is what is the volatility average as compared to the benchmark in this particular fund? How have you designed it? How have you strategized it that way?
So I think we are not looking at trying to measure the volatility per se. So when we invest into these stocks and the companies, we invest from a long-term perspective. And the volatility is caused by the fact that you invest with a certain outlook that you have on particular sectors or stocks, which may take time to pan out. So, I would say that the fund has been overweight on the auto ink sector and capital goods sector for some time. Quite early, and these sectors underperform the market in the early phase of rally, where the sectors like IT did very well. So I think the fund, and then when these sectors picked up, the fund has done very well. So I think it's the positioning that the fund has, and where whenever the market catches a momentum or market sees it. As a fund manager, we have to be always early in terms of investing, and that is where we can create a portfolio where the returns will be superior. So I think this would always happen, that you invest early, and the returns sometimes may be immediate, sometimes they take time to fructify.
Sure. Sohini, we want to know the investment style that you actually follow in this particular fund. How have you strategized it? What is the mix of investment style that you really adopt for this fund?
So we are a very bottom-up stock pickers as far as this fund is concerned, and it is very agnostic to any sector or any particular style. Generally, we have a more emphasis to growth because I look at the long term growth that the businesses can deliver. Basically, the longevity of growth provides an opportunity of compounding in the portfolio, and you can hold the stock from a longer term, long period of time, even 5-7 years or even more, if the company continues to deliver. So we prefer that, but we are not restricted by doing only that. But largely, you will see a growth bias, I would say, in the portfolio.
Sure. Sony, what exactly is the exposure in sectors? Which are the leading sectors? If you could just call out at least top five or top seven of them.
Yeah, sure. So consumer discretionary is the largest sector that we have, where almost one third of the portfolio is invested. And within that, half of that exposure, so about 15 to 16% exposure is to auto and auto lines, and the rest of the half of the sector within consumer discretionary is into other consumption names, into textiles, into hotels, kind of a sector. So that is the largest exposure, followed by industrials, which is again a large exposure because we believe in the domestic capex recovery cycle. So that is about 14-15% exposure that we see. Financials is another sector where again we have about 15-16% exposure. If you also consider the credit rating agencies as a part of financials, then it is again the largest sector. Other sector where we are overweight is cement. The domestic cement sector is again a sector where we have about 7-8% exposure and an overweight in the portfolio, I would say. So largely, the fund is more focused on the domestic growth, I would say, while there is also an export element which is involved into the companies that we've invested. But the domestic growth momentum is largely what we've tried to capture.
Sure. Sure. I really want to dissect the reasons, and the kind of data you have to back up this kind of a selection. Talking about consumer discretionaries, now that's a very rare top sector in any fund. What are the factors behind it, and how exactly are you looking at, especially talking about this new financial year and coming up 2-3 quarters? Right now, we are on very strong grounds, but do you also believe that the growth that we are witnessing now is, can go more aggressive or maybe a better quality of growth, which is why you have a major exposure in this sector?
So first of all, when we say consumer discretionary, it is not one sector. So as I said, that half of that is auto and auto ads. Then the rest of the half is again divided into the pure consumption stocks like the likes of Page Industry, hotel stocks like Indian hotels, and some of the textile oriented stocks. So I think it's a diverse exposure. So it is not linked. The fortunes of these companies vary significantly from each other. So while it seems to be the largest sector, but again a lot of diversification within that. And generally, when we pick up the companies, it is more based on the view on the individual companies more than trying to catch a sector and the rally in the sector, because unless we feel bottom up very positive on or confident on the growth of a particular company, and whether they are investing enough to get that growth, and whether the growth would be profitable, whether the company will be able to generate returns in excess of their cost of capital, we are not so inclined. So I think those factors go a lot in deciding what our holdings are. If you look at last 1 year, we've not bought into new stocks. The whole CY22 largely, I think we focused on adding position to our existing holdings only, because last year was a year of consolidation for the mid cap segment, where mid cap category returns were like 4-5%. And we utilize this to build into the position that into the stocks that we like. So we increase the weight of the stocks where we liked, and we've not really gone to add new stocks in the portfolio. So generally, what we buy into, we hold from a long-term perspective, and it doesn't keep changing from a quarter to quarter or from a 6 months perspective.
So buy and hold has been one of the USP of this fund also, and SBI Magnum Midcap Fund aims to focus on fundamentally strong companies and have solid management and sound business models, and those that have the potential to grow and become leaders of tomorrow. But then now let's talk about a few quarters ahead. Any specific sector that is there on your radar, and maybe it's not in your portfolio right now, but then you really want to take a look at it, coming forward in few quarters.
So, we have been underweight on the IT sector for quite some time because IT sector saw a significant rally, in the, post the COVID materialized, and that was one of the first sector to rally as people work from home and a lot of business went digital. And since then, we believe that, a lot of investments have gone into IT, and now we are seeing a bit of a slowdown into IT investments kind of a thing. And we've been underweight on the sector, and we've cut exposure there. So, because the valuations had significantly run up, it's not that we don't like the businesses. We definitely like the businesses, but we didn't like the valuations. So at some point of time, if we believe that valuations are, factoring in the slowing down of the growth, we would look at the sector again. That is what I would say. Rest, I think we are still positive on the sectors where we are already overweight, and will continue to own them as well.
All right, let's talk about the Q1 results. Sony, what are your expectations, and how do you see the tone of the market being set once the results start coming up? What is there on your radar?
I think given what we saw in the fourth quarter numbers, where the what we've seen for last 2-3 quarters is that earnings are generally revised upwards. There is a positive bias in terms of the numbers coming, and in this quarter also, I think while on the top line side the positive surprises may reduce, though we are not expecting a negative surprise there. So I think there is a good growth momentum, and this quarter also should see a continuation of that good momentum as we go into the first quarter as far as the top line is concerned. On the bottom line side, I think it is a mixed bag. For the manufacturing sector companies, I think we'll see margin expansion as the material costs are coming down as many of the commodity prices are coming off. So I think whatever high inflation what we saw and the margins were squeezed a bit, we are seeing a reversal of that, and hence the margin expansion will also materialize over here. In case of financials, I think the financials saw the expansion in the yields first, and the cost of funds kind of are catching up later. So they should see some squeeze in the margin. So I think it will depend from sector to sector. IT is another sector where we think there will be some pressure on the margin, given that the top line is kind of slowing down. So it would vary from sector to sector, but I think net the earnings season should be still quite decent, and we should not have any large disappointments, I would say. However, whether there is a significant scope for a further, upgrades in the earning, I think it upgrades in the earning incrementally would be far lower in the quantum. That is what I would say.
Any sector in this current environment or in your portfolio which is overvalued and which might see an exit later?
I think the segment, mid-cap segment is overvalued. I think, as I told you, that last 5 years returns for the mid-cap segments have been 17-18%, while the earnings growth has lagged. So the market is already factoring in a good earnings growth, at least mid-teens kind of an earnings growth, 15-16% over the next 2 years. So that is already in the price, or even slightly more. So yes, we are overvalued as a full. I think across sectors, I would say. But if the earnings continue to be delivered, then I think the valuation may sustain till we don't see a start of a downgrade.
Interesting. One last question, and then we wrap up the discussion, Sony. So, usually when you are investing through a mutual fund, it's always advisable to have a longer term strategy. You need to have a view of at least 5 to 7 years or more, and especially in a mid cap category, which is highly volatile. Now, because we are seeing this space being so overvalued, all those people who are currently witnessing some kind of profit in their portfolio or in their fund per se, would you advise for a part profit booking, or you think if you're invested and if you have a goal tied up to it, so just maybe think of increasing your investment amount?
As we can clearly see that the market has rallied significantly. So from a near-term perspective, the overvaluation always creates a risk in terms of a near-term, returns. However, if you see mid-cap as a category from a long-term perspective has delivered, mid-teens kind of a return from a long-term perspective, and that is a decent return to have given what other returns you get into other asset classes. So it depends upon what is an investment horizon that people have, and how much of their overall allocation is into this segment. If they are already over allocated to this segment, I think they can look to book some profits. If not, then maybe they can gradually deploy their funds.
Alright, that will be all. Thank you so much, Sohini, for being on the show and helping our viewers with the strategy in midcap and telling us everything about SBI Magnum Midcap Fund. Thank you so much.
My pleasure.
Alright, on that note, it's time for a quick break, but then post that we will discuss about mutual fund increasing their exposure in new age tech companies. What's the reason behind that, and what's for you in this? We'll discuss about this after this break.